This is a podcast by the Straits Times.
Hi, you're listening to a new season of Green Pulse, and returning as your original co-hosts, I'm Audrey Tan.
And I'm David Fogarty. And it's great to have Audrey back, who has returned to the Straits Times as an assistant news editor, focusing on the environment.
Thanks, David. It's good to be back.
We all know that nature is key to our well-being. Healthy ecosystems regulate our climate, protect us from storms, provide us with food and water, and offer boundless sources of recreation. In short, humans survive because wildlife thrives.
But the question is, who is paying for its protection? New financing mechanisms for nature have flourished recently, including debt for nature swaps and nature bonds. But how far do these instruments go in closing the biodiversity funding gap, which the United Nations estimates to be over US $700 billion every year?
With us today to tell us more is Ms Hoon Ling Min, Investment Director at GenZero, an investment company that finances projects that will help the world get to net zero.
So let's start this episode with a little quiz. I'm going to list a couple of financial instruments and you let me know whether they're either new, gaining momentum, or established. Ready?
Yep.
Sustainability-linked loans.
I think they're established, actually since 2017.
Green bonds.
They are also fairly established, in fact, slightly more established than sustainability-linked loans, first one having been rolled out in 2007 by the European Investment Bank.
Rhino bonds.
Oh, these are new. So just launched about a couple of years ago by World Bank to help increase the black rhino endangered species in South Africa in 2022.
Blue bonds.
This one's gaining momentum. I think the first one was initially launched in 2018 by the World Bank for the Republic of Seychelles.
Coral reef bonds.
New. So very, very new. First one having been issued this year in 2024 by the World Bank again to Indonesia.
Debt for nature swaps.
This one's actually probably the most established of the lot so far, dating back to 1987, where Conservation International actually supported Bolivia.
Carbon credits.
These are also surprisingly established, actually dating back to as early as 1997 when the carbon credits framework was established as part of the Kyoto Protocol.
And lastly, biodiversity credits.
I would say these ones are fairly new as well. The first one being a couple of years ago in 2022 when Colombia issued the biodiversity credits for the conservation of spectacled bear in the high Andes.
And what determines the maturity of these instruments, and how far along are they?
Yeah, so we sometimes like to think about maturity in terms of how long the instruments have been in the space, and you asked about when they were established, how long they've been circulating in the market. The determinant for maturity is also around the size and in terms of the depth and liquidity of the instruments. So how much have been traded, how frequently has been traded. So just to give an example, out of the global kind of GSSB market, which stands for the Green, Social, Sustainability and Sustainability-Linked Bonds markets, quite a mouthful in terms of the acronym, about 60% of them actually come from green bonds. So I think that goes to point that this is a fairly more mature market. But if we also think about, say, blue bonds, for instance, they still comprise less than 1% of the overall GSSB market, and therefore it's also fairly nascent. So I think the size in terms of the depth and liquidity really drives the maturity of the market.
Who are the buyers of such products?
Yeah, so actually, if I think about the main buyers of these products, ultimately a lot of it will still be driven by corporate action. And I would say corporate action in turn will be driven by two main factors, either regulations relating to compliance requirements or voluntary action in terms of the climate goals and targets they set on themselves. And that in turn is also driven by what investors require as well as what customers and consumers are looking for amidst the growing awareness of climate change and the effects associated with that. I would say that there are also drivers around disclosure requirements. We're starting to see more companies signing up to the TCFD, the Task Force for Climate-Related Financial Disclosures, or the TNFD, the Task Force for Nature-Related Financial Disclosures. So these are kind of driving forces to kind of propel corporates to think about purchasing some of these products. One good example is in the carbon credit space, where we talk about both regulatory forces and also voluntary actions. Within the regulation space, I think one of the momentous moment was when the Paris Agreement was entered into, and we have in 2015, and we have 196 parties who signed up for that, ratified the agreement, is legally binding to work towards having nationally determined contributions.
Nationally determined contributions under the Paris Agreement refer to emissions reduction targets that countries set for themselves. Countries can buy carbon credits generated in other jurisdictions in order to meet these targets. Projects that supply such credits can include nature-based ones, such as a forest protection effort.
Clearly, in certain countries or regions like the European Union, they're even more forward-leaning. I think more recently, they're thinking about rolling out the EU deforestation-free kind of regulation by next year under the EU Green Deal, which again will require all kind of commodities as imported or exported out of the European Union to be deforestation-free. So I think these are, again, on the compliance part, quite important driving forces that will cause corporates to take action. Equally, I think just outside of compliance market, we also see even those companies that are not regulated also taking voluntary action. And again, more recently, more than half of the world's largest listed companies have actually also made net zero commitments. So again, these are driving forces to what's causing the corporates to undertake action, at least on the carbon side. The other aspect maybe I can talk about is also on the biodiversity side. We are seeing kind of developments both at the global level and also selectively at the country level. So at the global level, we have the Kunming-Montreal Global Biodiversity Framework, which actually requires nations to come together to reverse or to halt kind of nature loss. So again, this moves towards kind of moving the market to think about biodiversity actions as well.
Climate action is measurable. One carbon credit, for example, represents 1 ton of greenhouse gas emissions. But when it comes to measuring biodiversity in nature, things are less straightforward.
Clearly, the biodiversity credits are still in the nascent phase of being developed, and that's being done by the Biodiversity Credits Alliance, which is also calling on action for collaboration, not just within biodiversity, but also with the carbon credit sector to draw some lessons learned from that. And we started seeing some semblance of maybe some countries trying to take early initiatives. Again, it's not quite a global rule regime that's been rolled out at this point in time because it's still under development. But some examples would be UK, for instance, coming out with their own biodiversity net gain law, which requires all developers to have a plan to increase biodiversity by at least 10% when they undertake any land development activities. Prior to them being able to secure the planning permit, they actually need to be able to prove that they can deliver at least 10% biodiversity net gain by the time they end the development. Similarly, in places like Australia, for instance, mining companies have a requirement to progressively try to rehabilitate some of the degraded mine lands before they can eventually exit the position. And that requires them putting up a financial surety or kind of bond to pay for some of these rehabilitation activities. I think the one final part of the puzzle is also just individual consumers. Increasingly, we're also seeing, as more climate conscious consumers also looking at purchasing some of these carbon credits products through some of the integrations that are available. For instance, when you make a flight booking, you can actually offset your flight using carbon offsets. Likewise, when you purchase an e-commerce product online, you could also think about purchasing an offset.
In the conservation space, scientists have been warning for years about the peril that the natural world is facing, and all these new financial instruments are really quite new, right? Whether it's coral reef bonds or rhino bonds. So what do you think is accounting for this? Why all these new tools are mushrooming up?
Yeah, no, absolutely. So to your point, actually, some of these instruments have been around for a long time. For instance, green bonds and carbon credits, spoke about them having been in existence since the early 2000s, so for a couple of decades. And we have other newer ones that have started mushrooming in the more recent couple of years. I actually think that the Paris Agreement was quite a pivotal moment in terms of introducing a step change and a bit of a paradigm shift.
Under the Paris Agreement, all countries have to take climate action. This is a key change compared with the Kyoto Protocol, the world's climate pact before the Paris Agreement was inked. That was a clear sign that when it comes to preventing environmental decline, it is all hands on deck. developed and developing countries, and the private sector too.
And following suit from then on, I would really say in the latter part of the last decade, so from 2015 onwards, that's when we start seeing kind of commitments made by some of the largest listed companies coming through. Here we are talking about large leading institutions who have a bottom line to protect, and yet they are still very actively committed to the cause. So I think this is where it really also triggered the financial sector to then come lean in a much bigger way, because right now then the opportunity set in terms of capital deployment is much more at scale compared to in the past being a very niche, especially small groups of environmentally conscious companies. And so I think the revival, or rather the acceleration of the private sector finance interest, then really took place in the latter part of the last decade and has since grown.
So in your thoughts, how effective do you think these instruments are closing that biodiversity finance gap? Because most of these projects, all these like nature bonds, coral reef bonds, rhino bonds are funding are very specific, right? Do they go far enough in achieving the scale that we need when it comes to protecting nature?
Yeah, absolutely. Audrey, I think as you already outlined at the beginning that there is still a $700 billion of funding gap annually. So it definitely points to the both the problem but also the opportunity sets that we're dealing with. And it's absolutely right that a lot of this financing are now undertaken at a project level basis, which that makes it all the more important that we have instruments or metrics or market mechanisms that can provide the standardization required to scale. I think it's all right for them to be deployed on a project-by-project basis. We've seen that in infrastructure projects before in the past. It is okay, but you need to have a unified metric that is replicable, that developers, that investors can look towards across all projects.
A major challenge to harnessing the funds needed for nature conservation is the lack of internationally recognized standards to quantify the costs and benefits to nature for economic activities. What do we lose when a forest is cleared? Do we count the trees that were lost? Or the wildlife that vanished? Similarly, how do we measure conservation successes when a forest is replanted or a coral reef is restored?
And this is why I think the carbon credits market mechanism is one that, albeit in stages of being refined, is still proving to be one of the more viable market mechanisms today. Carbon and biodiversity are actually very closely interlinked. Through the carbon project design, you can include elements around conserving areas with high conservation values. You can rewild certain corridors so that you can reintroduce species, and you'll be kind of bolstering the native flora and fauna species as well. So the interlinks between carbon and biodiversity from their aspects is actually quite strong. And we see the same even for mangrove habitats and blue carbon, for instance. Yes, there is the carbon sequestration potential from mangroves being 3 times that of terrestrial forest carbon. But we're also talking about protecting coastlines. We're also talking about creating livelihoods for the local communities around the marine ecosystems. So I think a thoughtfully designed carbon project can actually deliver some of the other core nature attributes around biodiversity, around community benefits, by clubbing the carbon performance with the biodiversity enhancements within the same carbon product. You can actually also monetize inherently the value of the biodiversity. So one example is what Verra, which is a carbon standard body and registry, is doing. They do have the CCB labels, which is the climate, community and biodiversity labels that allows for project developers to register for and apply for the biodiversity uplift based on these labels. And we've seen in some instances that these projects with CCB labels were actually able to fetch a premium. So again, that's one way of trying to monetize the value of biodiversity without kind of issuing a credit as standalone.
But what happens when it comes to a habitat that is not known to be a carbon sink? For example, coral reefs.
Yeah, so I think that's a tricky one. And I think it is for the reason that it fell into the new category that I think we're still experimenting with a little bit. To the extent the outcomes are quantifiable in a singular metric that can be replicable across other ecosystems. Maybe you're studying, I guess World Bank is now studying Indonesia in terms of coral reef conservation. To the extent some of the findings and learnings in terms of the impact metrics measurements are translatable and transposable to other geographies, then there is a possibility of doing that.
And just picking up on the idea of the value of nature, that's always been the hardest part, right? Carbon, you can sort of put a price on the value of drawing down or preventing 1 tonne of carbon from being emitted. Nature is much more complicated. How do you put a price on the value of a coral reef? It really depends from your perspective, right? If you're a tourism resort, a coral reef is really important to you, but it might not be important to somebody else. So how do you assign a value to that? And how does the investor then take advantage of that? That's always kind of or even the value of a rhinoceros, for example.
I think around how do we think about kind of the value of nature. So in some instances, and I like the example you gave, right, how an ecotourism operator might think about it differently. And I think that's where kind of even thinking about different combination of either financial instruments or revenue streams to make for the viability of a project quite important as well. Sometimes we think about nature or carbon in isolation when actually if you also club with some other economic activities. And that happens even in the space of forestry, for instance, where you can do conservation alongside kind of improved forest management where you still have some sustainably harvested timber for sale. Likewise, in regenerative agriculture, you can do so where you have the carbon credits generated from improving the soil organic carbon content. But at the same time, you also have crop produce that there are more sustainability produced that you can sell in the market as an ancillary economic stream. So I think if you think about it in the same vein, even for some of the other nature like investments where it comes together with alongside another economic activity that gives some mainstream revenue income alongside the conservation activities, that could be one aspect that financiers think about it.
Nature is in peril. About 1 million plant and animal species are at risk of extinction. And studies have shown that the populations of many wildlife species have declined by 69% since the 1970s. And when nature goes, so too do all the services that it provides humans, such as food and water provision, recreation, and many more. But can the financial sector help to correct this course?
Nature is complex. It's extremely complex. And there are it's a multidisciplinary approach. There are multiple stakeholders involved. On the one hand, I feel that all sorts of solutions and interventions around nature need to be grounded by science. So you absolutely need scientists, researchers, agronomists, ecologists, hydrologists. On the other hand, you absolutely also need the conservation organizations, the NGOs, to ensure that the community's interests and benefits are being safeguarded and upheld. Yet, for all of these things to happen, what do you need? You need money. You need capital. And this is exactly what the financial sector is here for. And this is where we've seen in various other industries that market-based approaches, market mechanisms are probably one of the few viable ways to drive and mobilize huge pools of capital into action. And by placing a price on carbon, a price on nature, a cost, it essentially implies the cost of destroying nature, the cost of emitting carbon. That will be the value of the financial instrument that inherently makes it tradable and investable. And so I think what the financial sector probably brings is the financial discipline around thinking about generating returns. Being profit-driven need not always be a bad thing because that in itself typically ensures there's longevity, there's permanence in the project that is in an ongoing basis.
But over the past centuries, capitalism has been a major driver of nature's decline. Given this, can we rely on market-based mechanisms and profits-making motives to save natural ecosystems?
The involvement from the concessionary capital, such as philanthropic organizations, from multilateral banks, from development finance institutions, are still of paramount importance. They're critical. At the same time, for a project to be solely reliant only on donors, only on grants, they've struggled in some instances to have longevity, to have permanence around the projects, because once the donor funding runs out, the project terminates. So I think this is where the powerful combination actually comes in between concessionary capital and the private sector capital, where we really see a critical role being played by the concessionary capital, especially in the early stage of the projects, where it's undergoing pilot feasibility studies, some first loss, guarantees kind of structure will really help to de-risk the capital for the financial investors and will help to crowd in the commercial capital, which will then bring the scale of capital that the market needs. I think there are probably a few things that need to happen. We need clarity of rules and standards. So that's around harmonization of standards and methodologies. We also need enabling regulations, clarity, and also stability of regulatory frameworks, be it around carbon or nature. The other aspect it's a challenge, but I'm also seeing tremendous improvements is around the need for the measurements to be real, to be verifiable, to be quantifiable. The other couple of aspects I think is also important at the infrastructure level, where you need a well-developed and functioning infrastructure in the form of, say, a carbon ecosystem. It's not just about the projects, but it's also having the advisory services. The carbon credits exchange and marketplace is also one good example to promote the liquidity and transparency of trading these credits. The other de-risking tool that will also be quite important to help to catalyze financing into the space is also around the development of insurance products. And these insurance products to cover the execution risk, because some of these projects are really long-term in nature, talking about 30, 40 years, where we're also subject to physical risks and also policy risk in terms of changes in policies.
So just as a final question, what are your forecasts for nature financing going forward?
Yeah, I think one thing is clear is the funding gap still exists, and it has been talked about for a while and is still there today. The other thing that is also clear is that there's growing interest in investing into the space. And I'm seeing it not just from, kind of specialist nature-based solutions funds, but increasingly becoming more mainstream. You have to see some of the more traditional asset managers also coming out to raise investment strategies that are dedicated to nature-based solutions. So the interest is definitely growing and is there. However, I think the big question here is, how quickly can the capital be deployed? And what would we need for this capital to be deployed on a big scale? And that, I think, is also dependent on the level of market and industry developments and maturation around some of the aspects I spoke about. Overall, I would say I'm somewhat sanguine in terms of the movement of nature financing. And I think that the way we need to get there is to move it from being a niche specialist kind of investing to something that's a lot more mainstream. There's something that the market can identify with and move at scale.
And well, that wraps it up for Green Pulse. Once again, I'm Audrey Tan.
And I'm David Fogarty. You can email us your thoughts on this episode. Links to our articles and how to connect with us on social media are in our show notes. This episode was edited by Hadu Rahim. Thanks for listening.
Send your feedback to podcast@sph.com.sg. Find us on Apple Podcasts, Spotify, or within our Straits Times app. Thanks for listening.